Hello friends, welcome. My name is Uday. The field of finance never stops surprising us. We continue to hear new terms every time which were not taught in conventional finance. Today, in this video, I'll explain in simple terms about negative interest rates and its impact on country's economy. If you feel that the video is informative, do like and subscribe. Share this video with your friends. Do comment with your valuable feedback and suggestions. I plan to cover questions like what is interest rate, what is negative interest rate, along with example, followed by the impact of negative interest rate on few of the economic factors. What do you mean by interest rate? Interest rates are often defined as the price paid to borrow money. Let's take an example. Suppose a customer has a savings account with the bank and holds INR 1000 as a balance in that account. What does an annualized 2% interest rate mean? It means the bank, which in this case is the borrower, must pay an initial amount of 1000 plus an additional INR 20 every year to the customer, who in this case is the lender. When you deposit money in an account at a financial institution like a bank in this case, you are effectively becoming a lender, letting the bank use your funds, and the institution effectively becomes a borrower. Now, what does it mean when we have a negative interest rate? This means a scenario where borrowers are credited the interest instead of being charged, or alternatively, a lender is levied a penalty or a charge for holding money with the bank. Let's take an example of say minus 1% interest rate. This means the bank, who's the borrower, pays the customer, who's the lender, INR 990 after a year on deposit of INR 1000 today. I hope this helps explain the concept. With negative interest rates, cash deposited at the bank yields a storage charge rather than an opportunity to earn interest income. Note that negative interest rates are generally charged by central bank of a country to the commercial banks that do business in the country. How it works. At first glance, negative interest rates seem like an unnatural strategy. Question here is, why would a lender be willing to pay someone to borrow money considering the lender is the one taking the risk of loan default? There are times when central banks run out of policy option to stimulate the nation's economy and turn to desperate measure or unconventional monetary policy of negative interest rates. Central banks impose the drastic measure of negative interest rates when they fear that the economies are slipping into a deflationary spiral. Because in deflation, there is no profits, no growth, and dropping prices. With negative interest rates, the idea is to incentivize banks to loan and spend rather than to save and hoard. The overall goal is to reduce the cost of borrowing so that people and companies are more willing to invest and spend. Let's take a look at the impact of low or negative interest rates on the financial market. We'll start with cash first. If banks happen to pass the negative interest rates to customers, the demand for physical cash or banknotes will increase. Why? Because people will definitely prefer cash over bank balance. This drain of cash from the banking system could lead to a rise in interest rates, exact opposite of what the negative interest rates are supposed to achieve. Bond yields. Bond yields will fall and in turn will be negative for bonds. Bonds as an investment destination will be less attractive. Prime lending rates. Because banks can lend to customers at lower rates, this will help boost the demand for credit in the system. Negative interest rates will reduce the tendency to save with banks, making it difficult for people to build up enough retirement savings. There will also be a disincentive to keep money in the bank, thus breaking down the banking system even further. Investors might also end up investing in high yield, riskier assets or unproductive investments. Let's go on to the business. Obviously, it will benefit corporates as businesses can obtain capital with cheaper financing and make investments in their operations for lower cost. But on the flip side, it can also result in companies that lack business models to survive indefinitely. In all these cases here, lower cost of financing will help people spend due to availability of credit at lower rates, thereby pushing the demand side of the economy. Whereas this could also lead to inflation as asset prices can soar. The government may continue to borrow because of lower cost of debt. This could also serve as a disincentive for fiscal discipline, perpetuating the debt-driven growth model. Let's check the impact on local currency. Lower interest rate causes local currency to depreciate, thereby weakening the demand for this currency. Weaker local currency, as we know, should stimulate demand for exports and hopefully encourage business to spend more. Stock market. The relation between interest rates and stock markets is quite complex. But for discussion's sake, as a general rule of thumb, when interest rates are lowered, it causes the stock markets to go up. But this is not a guaranteed outcome. Bank stocks normally tend to perform unfavorably in times of lower interest rates. Going by the historical evidence, the idea of negative interest rates does not seem to work, as Japan has been experimenting with quantitative easing and super low to negative interest rates for more than 20 plus years. Monetary policy can bring forward future demand to today by engineering lower real interest rates. Borrowing growth from the future is not sustainable. If you feel that the video is informative, do like and subscribe. Share this video with your friends. Do comment with your valuable feedback and suggestions. Thank you.